Okay, good afternoon, everybody. Today is Friday, January 20th. This is your weekly take on the market. I will be your host. My name is Scott St. Clair, the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody here at IBD is licensed that I'm aware of. We don't make buy, sell, hold recommendations. So please think about this disclaimer before we get into the video. So I'll do my market thoughts, some slides that I found this week. I usually find interesting charts almost always in Twitter or newsletters that I see, or maybe there's a podcast or something. I mean, there's just so much information out there floating, both good and bad. You can kind of get lost in it. And then we'll do the industry groups, some stocks that are on my radar, and then the quote of the week. So if you've ever seen the video before, it's pretty standard. Tend to follow the same path. So I guess market thoughts, should I go to the indexes, or let's jump right into the chart here. And it's the BofA Global Fund Manager Survey, their allocation to US equities. And you can see the spike down January this year, and you can see previous spikes almost always are in tough periods or bear markets. The one that's really interesting to me is the 05 spike and all those blue bars. Now remember, this is underweight US stocks, and in 05 you kind of had the start of the whole BRIC thing, the emerging markets. BRIC was the acronym for Brazil, Russia, India, China. Commodities are going crazy, kind of very similar to the setup we have now. China's booming. There's a lot of international ETFs that are at or near new highs. Commodities, gold seems to be doing pretty well. There's some commodity stocks, Rio, BHP, that are acting well. So it's a very similar setup. And you have a lot of bars there, and the market was good from kind of that 04 to roughly 08. The indexes really didn't start to feel the pain of the crisis until late 07, early 08. I guess I'll pull up a chart of the S&P. And so you can see, here, I can tell you in June of 07, right in here was kind of the beginning of the crisis. So Bear Stearns had a couple of hedge funds that failed. They were buying mortgage-backed, blah, 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 whatever. And the firm I was at, I was a, kind of a old school stockbroker at the time, went out of business. And it went out of business in a hurry. Like, there was like Friday was like, there might be something wrong with the firm. By Monday, we were like, maybe it's going to survive. And then one day, we got an email, disaster, the firm may be forced to close. The email was dated June 20th of 2007. I just pulled it up on the internet. I was curious. And I remember I went to Scotland to play golf, and had this golf trip planned for forever. So I wasn't going. I had to go. I was gone, and the firm literally closed its doors while I was in Scotland. I had a friend call me and from work and say, you have to get your stuff, and you want me to have your desk and all this stuff that you own delivered to you. So it was very hectic. It was crazy, but you can see the market kind of didn't care. Now, we were a little local firm, but it was just kind of the canary in the coal mine was the Bear Stearns fund, which caused havoc for our fund because we had a broker that was buying the same stuff, trash that the Bear Stearns fund had, and it just literally went to like zero. So, but you can see how it just kind of shook it off, and then it just got worse and worse and worse. So, but here is that kind of that chart where the outperformance of, or the underweight of US, but the US still went up. It just probably went up relative to emerging markets a lot less. And there were stocks like PetroChina doesn't exist anymore, but and Potash might not exist. So this might be really difficult. But look at Mosaic, from 20 to 140 in that time frame, and CF, I think, and how about like Southwestern Energy, I think, more a little bit down here, but you get the idea. So it was that was kind of the era of commodities and international. So that's why you have that kind of underweight. And maybe that's what happens here. I sort of feel it. I think that could happen. It could have the same kind of setup. So a lot of blue bars, underweight US stocks. Doesn't mean US stocks can't go up. They may just go up less than their brethren. So this might be, it's probably very similar to what you just saw, but it just scaled a little differently, and you can see the positioning. They surveyed, I didn't realize, 253 global fund managers, $710 billion in AUM. AUM is, assets under management. So you can see the underweight, they're overweight bonds, utilities, cash, underweight US dollar, tech, equities. And maybe that's why you're getting the kind of relief rally that we've seen so far this year. All right, so yeah, here kind of what I said. I was going to build a slide with all of the points that they had made, but I think it's just got to overkill. I apologize. I was just going to delete this slide, but the bottom line is they're overweight cash and bonds, underweight stocks. Guess what? Stocks go up. All right, so let's pull up the industry groups before, let's pull up the indexes, talk a little bit about what's going on now. And let me pull up the NASDAQ. So today was a really good day in the markets. You had this bad break here, and you did go lower yesterday, Thursday, but you didn't get any kind of follow through day, which is a really bullish signal for me, was the fact that, you have this bad break and you should go lower. And anytime that, one of the best signals is when the market should do something. Now you have to be careful what you think it should do, but if it, it should go lower and doesn't. So like you get a bad break like this, or you get a reversal of upside and then a bad day and then a gap down, it should get some type of continuation, even if it's just for a day or two or three. So look at this bad break, and then bad break. So maybe it could still do that. It seems unlikely though, because of how much it's come back. So you get a bad break, boom, boom, boom. You get a bad break, boom, boom. You should get some type of follow through to the downside when you get that, and you didn't get that yesterday. So today the market was up. Let's look at the S&P. I wish the chart didn't do that, but we'll fix that. You're right on this line, which I saw somebody tweet that either taxi drivers or even telling them about the 200-day on the S&P. It's really, you've got like this really trend, 1, 2, 3, 4 times you've tried that. If you go to the weekly, you've got this trend 1, 2, 3, 4 times on a weekly, and maybe it finally comes out of that. I don't know. So it's squeezing. Maybe it's squeezing. You're getting like this, and that usually leads, these type of triangles can lead to a move, maybe a move out of it or a move down. My bet, at least with my money, is a move out, but I'm open to being wrong. but I felt like if I was wrong, it should have gone down. Boom, boom, boom. It should look more like if that triangle like that you should have done more like that. Maybe not that bad, but you get the idea. And then, so you've got emerging markets. This is like, I didn't do the math, but it's like a 40 or 50-day high, and relative to the S&P. So you have a high here on 816 at 431, a lower high here on 1213 at 410. Let's look at emerging markets. So 816, you've got this high, right? And then what did I say? 1210, something like that. So a little bit lower, but now this high is you actually have a higher high versus the S&P and the NASDAQ. So they have, so far anyways, lower highs. Now EEM has exposure to China. I can't remember. I looked. I think I did look. It's 31%. It's a lot. And I knew it was high, but that's even higher than I expected. 78% exposure to Asia. I own EMXC, which is emerging markets ex China. Probably, I didn't look, but probably huge exposure to Asia, which I don't mind. That's fine. I just wanted to remove the China. Not that I hate China. I just felt like I had missed the China trade. Here's KWEB, 17 to 34. It's doubled. I feel like I wouldn't want to be short it just because it doubled, but I feel like some sideways action seems appropriate. So that's why I'm in EMXC. But same kind of concept, like, high, lower high, barely now, not quite higher high, but close. And then DTH, which is international with more value / income oriented, has some Europe exposure. You can see the yield on it is 5% roughly. This looks interesting to me, and it's something that I do own. And, so if I just put my bearish hat on and say, okay, well, what looks bad? I think the U.S. market doesn't look all that great, doesn't look terrible, but I think Mexico, yeah, there's something I wish I owned. Mexico, let's look at the weekly. So, monthly is that not quite an all-time high, but, coming out of a long base. EWW is Mexico, EWG is Germany. I don't know, not like I'd buy Germany, but does that look bearish to you? If that was the US market, you'd be pretty excited about that. What else there's a lot of EWs. If you go down, you can see a few, there's Australia and Canada and stuff like that. So it seems like, the FTSE felt like I saw that the FTSE had made either a 52-week high or an all-time high or something. So it just doesn't seem bearish. Like, if it's bearish, why are all these markets going up? And you also have, stocks that aren't going continuous, and they're not going down on bad news any longer. So Netflix's report, I didn't get into the weeds of it, but just on the surface, that looks awful. Earnings down 91%, 12 cents versus the $1.33. Revenues up 2%. It can't grow anymore. Stock up 8% today. So, and I know Reed Hastings stepped down. Maybe that was built in. People knew that was coming, but again, that's bad news, and the stock's not going down. I think Salesforce got a downgrade today, and the stock didn't go down. The poster child of bad news, stock don't go down, was Tesla. On this day, got as low as 101, gap down. I think it was down as much as like 13 in the pre-market, closed up that day. So this stock is now 30% off the low, with price cuts and things like that. So you just see, these are all things you can observe and, help you to, build your model of, where the market's going. It's not easy. There are failed breakouts. I think IBKR, it didn't work. I feel like there's a couple of others that don't work. Got to be selective. You got to kind of pick your spots. But there are places to be invested. We'll talk about that with the stocks. So I don't know. I'm kind of all bulled up, is what I said on IBD Live, and I have big exposure in DTH and EMXC, and had a little bit of U.S. exposure today in ETFs like the SPY, and I own some individual stocks, and I have very little shorts. I have a tiny short position in Tesla and a tiny short position in can't even think of the other one. That's how little it is. It's like exploratory, and Tesla's not working. It's not hurting me because it's pretty small. I actually like seeing it in my account. I can see all green, up, few little losses and newer positions I've taken that haven't gone anywhere or whatever. And then there's Tesla with the loss, and it just reinforces the idea that you don't want to be short, you want to be long. It's one of the best feedback mechanisms is what your portfolio is doing. Where are you making money, if at all? That's why I like having short exposure. Not everybody likes it, but that's one of the reasons I like it. Honestly, the way I'm positioned, I hope Tesla keeps going up, because that probably means that everything is, all the others are going up. Okay, so let's go to the industry groups. And oil and gas field services, number one. Schlumberger reported earnings. I think it was a little bit of, buy the rumor, sell the news. Stock didn't do a whole lot today. The earnings are really good. I don't think anybody is surprised by that. It's kind of sitting on top of the space. To me, the buy point, sort of a buy point, definitely a buy point. I bought it there. And I sold it yesterday, not because of the earnings, but because I needed the buying power. Gotten to the point where, because I have so much exposure in those ETFs, because I can lever up or I can, increase I don't have to have a 5%, 10%, 15% position in ETF. It's an ETF. I can have a 30, 40% position in it. So you can really increase my size because of the diversification within that ETF. These are broad-based ETFs. It's not like the solar ETF or gold miners ETF. So I needed the buying power for AEHR. I wanted to buy more of that, and so I just sold it. So it's kind of weird that this is the first time in a long time where I've gotten to that point where I have to kind of search around for buying power in my cash accounts. I can't remember last time that I had an order rejected by my broker for buying power, and that happened to me in my Roth IRA yesterday. So I was like, oh, wow. I do own some bonds that take up buying power, and I can always sell those, I guess. But I'm trying to buy short-term bonds because, the way, I guess, TD Ameritrade, I saw, they pay 35 basis points when you sit in cash. And so it just drives me crazy to have anything in cash when you can make 3.5%, 4% in 90-day paper or whatever. So tenfold, that's what they do. And I understand the broker needs to make they need to stay in business too, but that's what they're doing. They're taking my cash and buying 90-day paper and giving me 10% of that back. So I cut out the middleman if I can. The only downside is I have to manage the cash a little bit, which is very strange. I haven't had that issue in a long time. So another clue to me, maybe, that the market was shaping up possibly. All right, so this is a good group. TDW is a good one. Unfortunately, I don't own that, but that was the buy point to me, or you could have bought it here or here, but acting really good. What other group? Retail department stores, steel producers, machinery, construction, mining, retail, wholesale, just one stock, apparel, shoes, retail pair of shoes. Gold is starting to shape up a little bit better. So mining, gold, AGI, it's kind of sleepy, kind of quiet, but breaks out through 9 and change. It is up 21%, but see how it just kind of stair steps higher, stair steps. I feel like it's up or down 10 cents every day. So far, been pretty easy to hold. So that's interesting group. I would guess that the other mining metal ore group is here. It's number 13. I think that group's a little bit more dynamic. If you get it right, you'll make more money in these stocks. If you get it wrong, and hopefully you can get stopped out just like anything. But Rio, if the yield is anything close, almost 9% coming out of this long base. And look at the monthly chart of Rio. Very interesting to me. It reminds me, look, it's not Microsoft. They don't have the margins probably of something like that. But you've been in this 15-year base. And if you remember what Microsoft did when it went through, so here's 2009. When did it come out of its like long base? 2015. Like this would have been a little early here. But if you really waited for it to finally come out, right there to me is like, big month up at 19%, all-time highs, all-time highs, coming out of a long base, and probably thought was real sleepy. I know I didn't buy Microsoft. I haven't owned that in a long time. And so that's 54 in 2016. Fast forward to now. That is right there, I believe. Did I do that right? Anyways, somewhere in there. And so that's 45 to 300 at the high. So really big move, but maybe that's what you can see in some of these, here's BHP, same kind of thing. Big base. I don't know. It's possible, but we'll have to wait and see. But if there's like a sea change, then they have a lot of room to go. And I've seen charts on, the copper starting to move. SCCO made a really good move out of its base, and the inventories of a lot of these base metals are depleted. And if we're all going to be driving around electric cars, I think I'm gonna butcher this, but I think electric car has 6-9 times the amount of copper that a regular car has. I saw that, heard the number a few days ago. It was a lot. So it's definitely in demand, and to get a copper mine open. I think there's a copper mine. It's called Revolution or Resolution or something. And it's a joint between Rio and BHP, and they're in year 27. 27 years of trying to get the copper mine open for permitting. So these can go a long way if the demand for copper, if the demand for EVs is truly what people think is going to happen. Back to industry group. Sorry, I got off track a little bit. Oil and gas drilling. I took profits on VAL. I like that one. I don't know why I took profits. Sometimes it's just in my nature. I like to sell into strength. The problem with that is, like, I was really glad I did when it did this, and it gave back like 5 days worth of gains in 1 hour. But then it's like, how do you know to get back in? Because at 70, it looks like it's going to go lower. So I was hoping that it would come down a little bit more, and didn't. So that's the hard part about taking profits. Sometimes that's where I get shut out. So I like this group too. And so there's like a diverse area of stocks to own. We'll talk about that in the next section. Excuse me. But so I don't know. The industry groups aren't really telling me a perfect story just yet. I would like to see semis in there, but there are some semi stocks that are acting really well. And so there's areas to be invested, I think, until otherwise noted. Okay, as far as stocks, semis, let's go AEHR. This is my favorite because it goes up the most. 70 is the rank, but I think that's a bit deceiving because it might just be a really large group with a lot of stocks in there. Let's see here. Excuse me, there are 29 stocks in there, but this stock has, ever since it reported earnings, gaps up, follow through, tries to pull back a little bit. Yesterday, you finally had a little bit of a pullback, but it can't close on the lows. It reminded me very much of like this day. So I bought more yesterday. That was, like I said, I wanted more exposure there, and I ran out. So I took the Schlumberger money and moved it into there. And today, it's just a barn burner. Now, it's small, it's volatile. What's good on the way up is bad on the way down. Keep that in mind. So it's been a little hard to hold when this kind of size I'd like. So I don't, but so far so good. And it has everything that I'm looking for, earnings and sales. Now it is a small company as far as the base, 14 million in sales for the quarter, but today they announced a $25 million contract. That's more than they did in the last 2 quarters combined. Now I don't know if that's a if that, I didn't get into the weeds. Is that a contract for 6 weeks or 6 years? I'm most concerned with most of my is here. Let the market vote. I'm going to let the guys and gals that are much smarter than me vote with their money, and I'm going to try to go along for the ride. So this looks very good. And ACLS, just another stock I'm just lamenting that I don't own. I bought this right there thinking it was a double bottom. And what bear market, right? Look at ACLS through last year. Now, wasn't easy, a couple of tough rides, but if the funds, the guys that they're not worried about this, they just buy it. And so, to them, it's if their average cost is 60, stocks 100. So acting really good. And then there's some others like Laser Corp. And that should be clickable. I don't know why it's not LSRCY. I do own Laser Corp. Building this double bottom, Japanese. ATEYY is a Japanese semiconductor test equipment. I do own this. They are pretty illiquid. They trade overseas in Japan, obviously. So they just kind of open where they closed overnight. And then they'll kind of front run what they think the market will do in Japan the next day based on what the US market does. But, that most of the price action is going to be baked in, which is why you get these, it looks gappy. And this is the company's been around for a while. So this is coming out. If this were to exceed that, it only just started trading as a over-the-counter stock here for us, a few months ago. But it's coming out of a long, long base. And I like semiconductors, like I've mentioned 100 times. I think it's every big cycle I've been in, there's always been 1, 2, 3 semiconductor stocks that lead the way. 1995, C-Cube was one I owned. AMAT was great, but C-Cube was like the stock that got my account going in 1995. C-Cube doesn't exist anymore. I don't remember how they got bought out or something. And then, Intel, and then a couple of the other, like, I wouldn't necessarily call them chip stocks, but like JDS Uniphase, stuff like that in the late 90s, early 2000. And then Nvidia and AMD recently, and so on and so forth. So this is the group I really like to see if there's potential leadership here. In oil and gas refining, you got Valero coming out of this long base. I don't really, it's tougher. I think when you buy them coming out of longer bases like this, you have to be a little bit more patient. And no surprise, I'm not the best at that. I'm trying to get better at it, but this looks, it's hard to argue with that strength. And, the earnings and sales. And, I'm not an expert, but the last time somebody built a refiner probably was like 20 years ago. Again, these are things that are just really hard to build. Semiconductor plants, things like that. So these guys have a stranglehold. There are others, of course, like, down here, they're doing well, but Valero is done really well in the earnings and sales show. And I think I already mentioned like Schlumberger, previously. So I have there's things that aren't that are not correlated that you can kind of be semi-diversified. Look, our style is not to be that diversified, concentrated, and I think I own 8 stocks, something like that. But it's not 8 semis, it's not 8 gold stocks, it's not 8 solar stocks, or so I have a little bit of diversification, which makes it easier to, to position. You don't have to, it's not kind of an all or none bet. All right, so I think those are all the stocks that I wanted to mention. I'm sure there's a million others. But those are the ones that jumped out at me. And okay, quote of the week. Michael Marcus, Market Wizards. I always they're my Market Wizards is my go-to. There's so many books and so many great quotes. So if I kind of get stuck, I didn't have that, anything that I was like, oh, I want to use that. So I was thinking about this, and I think this is so true. So every trader has strengths and weaknesses. Some are good holders of winners, but may hold their losers a little too long. Others may cut their winners a little short, but are quick to take their losses. As long as you stick to your own style, you get the good and the bad in your own approach. That's what's important. I don't know why that the market knows, but if you try to cherry pick, well, I'm going to hold this one, I'm going to short-term trade this one, I'm going to day trade that one, you're just going to be all discombobulated, and you're not going to do well. It's my experience. You just kind of have to go with the approach you have. My approach, though I'm trying to expand it slowly but surely, I don't want to make a big change, but my approach really is to, I'm not a great holder of winners. I tend to sell them into strength, or sell some of them into strength, but I'm not a good holder of losers either. And in other words, I cut my losers really quick. Like, it's rare for me to have a stock that I'm down on in my account longer than 2 or 3 days. Like, I have to be really stubborn to be down on something. And even a little bit, even if it's only a couple of percent. Now, if it's, it's a few $100s or something like that, I'm not going to, run to cut the loss. But if I'm down a few $1,000 or 3% or 4% or 5% on something, I let it go. I can always revisit it. So that's the good and bad in the way I do it. Other people, they might not sell their losers so quickly, but they keep their winners much longer than me. And so it pays for those losers, because every once in a while you stumble upon a monster, Tesla and Apple and Nvidia, and they can pay for a lot of losers and then some. So stick to your own approach, figure out what style is best for you. The best setups are the ones in which you have all three things going for you: the fundamentals, the technicals, and the market tone. It's CanSlim right there. So the fundamentals, you want to buy stocks, ideally with earnings and sales and return on equity and margins and group strength. They don't have to have everything. I can buy Rio, even though the earnings might be down on the chart, but the group is strong. The macro tailwind, at least what I see, seems strong. If the charts I saw on inventories on all these metals are even halfway true, nobody has any of this stuff. And these are all things I can use to build my fundamental thesis. Then I use the chart to try to time the buy. That doesn't mean I have to buy it breaking out of a cup with handle. I can manufacture my own kind of buy point, but I know where I'm going to buy it, and then it helps me to know where I'm wrong. And then market tone is so important. I know I've mentioned Bill has said before that he probably should have used the M first for CanSlim. And I'm not, and I've said it before, I'm not great at the market. I think the overall market does a really good job of kind of fooling you. So you have to, I don't, if you have that problem, if you don't have that problem, I should say, great, congratulations. But I do know that I have that. So I'm wary of it. No, and I, when I think the market's really bad, I always say, remember, Scott, it might be trying to fool you, and vice versa. The overall market, when I think it's really good, hey, Scott, it might be trying to fool you. So I'm very, I don't know what the right word is, but the market tone, overall market tone is super, super important. All right, let's cut this short. MarketSmith at investors.com, or cut it medium. I don't know how long this one was. Hopefully it didn't drag on too long. 800-424-9033. I think next week is the Stay in Step MarketSmith webinar. Let me confirm. If it is, I get a week off, or I should say a Friday off, and I am wrong. So you will see me next Friday, but the following Friday on February 3rd, there won't be a video. So I'll be back next week. Have a great weekend, everyone. Thank you. Bye-bye.